Somebody commented on my last video asking why some people have to verify their income to get finance and others don't. That's a great question, and the answer is something called Stips. So let me break it down for you. Stips is short for Stipulations. It's basically a list of conditions that a lender puts on a deal before they'll fund it. Think of it as the bank saying, we'll approve this loan, but first we need to see proof of a few things. Now, here's the key thing to understand. Not every deal gets Stips. Whether you get them or not, it comes down to how much risk the lender sees in your profile. The stronger your application looks, the less they need to verify. The more question marks there are, the more they want documentation. So let's talk about the most common types. The first and most common is proof of income. This is exactly what it sounds like. Pay stubs, bank statements, tax returns, or an offer letter. Lenders want to confirm that the income you put on the application is real and consistent. If your credit's strong and your income looks stable, they may skip this entirely. If there's any uncertainty, you're self-employed, you just started a new job, you have gaps in employment, they're going to ask for it. The second is proof of residence. A utility bill, a lease agreement, a piece of official mail with your current address. This one usually comes up when your credit report shows a different address than what's on your application. Or when your profile's thin and the lender just wants to verify who they're actually lending to. The third is proof of insurance. Most lenders require full coverage before they'll fund a deal. This one's pretty straightforward. You can't drive off the lot without it anyway. The fourth is references. Some lenders, especially on subprime deals, will ask for personal references, names and phone numbers of people who can verify your identity, and whereabouts. This one catches people off guard because it can feel personal, like the bank doesn't trust you. But it's worth knowing that certain credit unions actually require references from every single member as a standard part of opening any account, including a loan, regardless of your credit score. So sometimes it has nothing to do with your risk profile at all. It's just that lender's process. The fifth is a down payment stip. Sometimes a lender will approve a deal but require more money down than originally discussed to reduce their exposure. This usually happens when the loan to value ratio is too high, meaning you're financing more than the vehicle's actually worth. So why does one person walk in and drive off same day with no paperwork, and another person has to go home and gather all kinds of documents? It almost always comes down to three things. One, your credit score. Two, income stability. And three, how long you've been at your current job and address. The more boxes you check, the cleaner your deal looks and the less the lender feels like they need to verify. If you're planning to buy a vehicle soon, the best thing you can do is walk in prepared. Know your credit score, have your last two pay stubs ready, have proof of residence in your phone. It won't hurt you, and it might save you a trip home in the middle of a deal. Drop a comment if you've ever been hit with Stips you weren't expecting, because I'd love to hear it. Follow Rides with Seth for more content like this.